All right, video 2, real quick. We're gonna full screen this, and we're gonna be going over liquidity with a little bit more advanced. Some of you guys have it's gonna be advances and harder to be advances than like you have never learned this before. Well, let's take Euro USD for example. We're gonna use that as an example, and we're only gonna be doing liquidity because I'm already in Euro USD. So for a swing, we'll just use that. Turn all this off. So this will change a lot of your tradings once again. I've kind of like been back testing this, and I've just personally discovered this. I don't know if anyone else knows this. I don't think they do. But this is something that I've noticed physically in trading that happens. So we're gonna look at just a random short and long opportunity, and then I'm gonna get into the meat and potatoes of this. Let me see. Trying to find a proper. Here it is. Okay. So there's EU short that happened, right? On the 1H, for example, right? There's two phases of liquidity, right? There's two phases of liquidity that occur, right? And one's internally, and then this is when prices like for example, this is specifically for shorts, and we'll go over specifically for longs in just a second. There's there's internally and then there's externally, right? And I know I've already talked about internal and external liquidity before, but this is going to be just a bit different, right? You have when price comes up and price does a displacement, right? That's this the how you explain this. The displacement is the last bit of liquidity that they're going to take to the very left, right? Normally, when they take liquidity coming up to chase buy side, or every time that they take liquidity coming up to chase buy side, they're always taking the liquidity in the highest to the left of you, right? Via the last impulse move, right? And if you're waiting for price to come into your POI and you know you have to wait for displacement, as you see happened here, and I'll mark up a few places where displacement happened. So for this, I'm going to be going specifically displacement higher, but I will mark up the displacement lower for just kind of like to help you train your eyes. But the goal of this video is to show you how to filter liquidity and get in earlier, potentially, or maybe even get 2 entries. And we're gonna I'll just pull this just a little bit through so I can show you that it did slice through. So this is obviously swing high, major swing low, displacement higher, displacement lower, and we can mark that up too. Displacement higher right here. And this is a confirmation that you're looking for. It doesn't matter how far down it stabs. So you can see this only stabbed down just a little bit, as long as it stabs down below that low. So you took buy side, you took sell side. Where did I say buy and sell side is on the major swing highs and lows? The sooner you get to be able to look at not all these small price moves in here and just the major swing highs and swing lows at first, then you'll be better off, right? So you got displacement higher and displacement lower there, right? That is going to be the last bit of liquidity, right? When it traded above the swing high, that's the last bit of liquidity, right? This whole move got taken, right? Via this whole move got taken. So you can count this too as a major swing high, but you're just looking for an immediate to the left, right? Swing high being taken. So boom, swing high was taken, displacement higher. That high was taken as well. So buy side is taken. What they have to do every time they take a buy side, they have to sell off and start pumping sell orders in these areas in order to chase sell side, right? Like prices doesn't just move. Like there has to be orders placed here in order to move price, right? Not retail orders too. Like the algorithm puts orders in for these banks and they're handling trillions of dollars and billions of dollars at a time, right? And there's like a video of this, like it's had to have been like the 80s or 90s of this guy. He was an institutional trader, you know, like as in he worked for a central bank, and he was handling like $750 million on that one trade. And the video was viral because he was sitting there nervous and sweating, and it just looks like a very stressful job. You know what I mean? He ended up winning the trade, but like, you know, the point is they have to manipulate price, and that they're taught and trained on how to manipulate price. Now these days, bankers are being fired and they're going more towards AI because of how the economy is going. But you have displacement higher anyways, and displacement lower right here. You could have gotten in on the displacement higher right here. As you can see, the strong high never got violated. The premise of the bullish candle right here, it never got violated. It fell short of it. So that is going to be the last bit of liquidity that they're going to take externally. Is just this specifically this displacement higher. Externally is classified as external liquidity. External, but let's be more specific. External price, external buy side. I can't spell external for some reason. Is when whatever. I mean, to save time, I'll say it and you can type the notes. External buy side liquidity is when price is coming up for buy side, right? And before the move down like that you were expecting, price takes one last bit of liquidity, which would be the displacement higher. And it would be that high right there. At that point, you could get in, or you can wait for more price action, and you knowing that they're going to gravitate towards this major swing low or sell side liquidity next, and wait for a proper entry. This would have been a sloppy entry. You know, you would have tried to use this order block right here, but you would have had a little bit of drawdown. My stops would have just been just behind the wick. The trade would have ended up working out, but I would have probably graded that entry a B minus or something like that. So at displacement higher, you can get in because now you know, right? Displacement higher has happened. You're in some type of POI, right? Displacement happened. We're going to do for example purposes, just to simulate that you're using, like, let's just say the daily time frame. So let's just say you have a daily order block right here. You had displacement higher into that daily order block. And now you know a few things, right? You have a you have a 1H displacement higher into a daily order block. I'm sure at the time you had ICT kill zone confluence right there. Kill zone was respected after the displacement higher, and you have a strong high. So as price action is moving, what happens? Displacement higher happens, right? Price ends up creating a bearish order block, which is then respected, bro. And it trades. Come on now, bro. You can wait for even more price action. It's then respected hella time. Respected here on my crosshairs. It's respected. This one order block right here, that was the last up candle before the move down, was respected hard. So many short opportunities here. It was insane, right? You had this one being respected right here. You could have taken that down. Second entry right here in this imbalance field, like you could have gone crazy, right? But the point is, the liquidity, you have to wait for a major swing high to be taken, either into your POI, or if it is not at your POI, like if it hasn't been taken in the manner that I just showed you, then that means this high right here is not going to be a strong high. That would be canceled. That would mean the high is going to be taken instead. And if you were to do this, because if there hasn't been displacement, that means there's going to be displacement in any long or short situation. If you have not seen it, it's going to happen. I usually will put my just above, and I'll look to the left to make sure. Look at when's the last time displacement actually happened. It's usually somewhere very nearby, up to the left. And then you look at that, and I always try to put my stop just behind the high. It's never too big. It's never too far away. So if there's a high over here or displacement that happened, then that's my trading range, and that's my strong high is where the last previous displacement happened. If this was not present, right? And I'm going to expect this swing high to be taken inside of my POI, my day higher time frame POI for a displacement higher, right? In that regard. And at that point, especially if they've already taken out lows, if they've taken out lows first and haven't taken out any displacement, but they took out a low first, you would have to wait for price to come back up and basically wait for more price action and wait for the displacement to happen. But I always expect, if a displacement didn't happen prior to me going into the POI and it goes into my POI, displacement is going to happen somewhere around my POI, because the displacement has to happen before the actual move even moves. So it has to happen every time. Get this back over here. All right. So that's the last bit of liquidity that you're going to see taken before the short. Make sure you have obviously there's going to be like more context to your trades as you analyze and things like that than just this, but I want to cover just this. After you've seen that happen, you can choose to get in, or if you're one of those ones that like to play a little bit more safe, there's nothing wrong with that. By the way, being too aggressive is really bad for you, but also being too conservative in trading is way too bad for you and makes you miss opportunities, right? So you have to have that fine balance between when to not act and when to act, right? And that comes with experience. So this would have been a strong high right here in this regard, right? At that point, I know this is a strong high. I know all the liquidity to the left at the point of my displacement confirmation has been taken, and that anything after price moves down, right? This is going to be my new trading range right here. It's called a new dealing range, and that basically means that price will be dealt within this range, and it would not exceed this high. If it was not dealt within this range, you'd have price coming way up here, violating this high. But instead, you're going to have, since you have displacement higher right here, and now you know they're coming for the swing low for the displacement lower, and you know that stop on your higher time frame, for example, in your daily, stops are, liquidity is gravitating towards the downside, right? You know that the day is going to be pushing, or the 4 hour or the 1 hour is going to be pushing from the downside to chase sell side overall, and you have displacement. After that displacement, sell. I'm not selling this bullish candle. I'm selling on this bearish engulfing as it's coming down. And once this closes, I will be getting the order in, because that's a bearish order block that happened after a displacement that happened after major buy side take right here on the left. So that's just a few liquidity confluences I have with this. If I were to analyze this fully, I would have like a POI and everything else, a higher time frame POI. But at that point, I know that when price action is printing on the way down to chase it on this low, that price does not have to violate this high, because one, this is a strong high, and two, all of the liquidity has been taken externally, right? Externally as in like outside of the dealing range, right? The dealing range is to be established when the candles are being printed, as the candles are printed, but the liquidity, all the proper liquidity to the left has been taken, right? I don't need to worry about price coming over here anymore. Every time price comes and takes buy side, it'll always be the buy side to the left, right? Look at this, taking buy side to the left, taking buy side to the left. So now that I know that they're done, this is my signal that they're done completely. It's over with. They're done taking buy side liquidity, and they're now going to chase sell side liquidity. And on top of that, you have markups, right? So this is external liquidity. They're to the left here. Anytime it's to the left, it's external. External meaning, like I said, outside of the range, the new dealing range is to be established, right? Your context is what I just told you. The buy side liquidity was taken. You had displacement higher. You had a strong high taken into a daily order block, let's just say, for example. And you had price falling down. Now you could get in at any time. You can get in at the respect of this order block. You can get in at the, I prefer some type of short-term high taken. And that brings me to liquidity number two. So you can think of what I just showed you about everything being taken to the left and the displacement being the last confirmation that you need for buy side liquidity being taken, and make sure this is into a POI or in a POI that this happens, right? Make sure it's a major swing high. After that, the left is done. That's it, right? Unless you were completely wrong on the trade direction, the left is going to be done. If you're wrong on the trade, price is going to come up, take that high, fill this imbalance or something like that, or hit this order block and shoot up and then take out your stop loss. If this is bullish and you are analyzing this as bearish, but if you are at least good enough to analyze the direction of the trend from a particular area, like I've been showing you in the education, then you'll be able to know, like, boom, displacement higher happened into my daily order block, into my 1H fair value gap, into my whatever, you know what I mean? And now the price action that prints after that, and then you have to think about the context. The context is to the downside. Price moves between swing highs and swing lows, taking buy side and sell side over and over again, as you see, over and over again. But that moves me into phase two of kind of my confirmations when it comes to liquidity. After all of that's happened, right? Displacement higher has happened, right? And let's just say you want to play it safe, and you play it a bit more safe, and you wait for some more candles to print, and you have your dealing range right here from this high to this low, right? And you know that it just took major sell side right here. What are you expecting it to do? Chase on the buy side, right? Again, now the average mind would expect you to be like, well, if it's chasing buy side, it's going to take out all of these highs right here, right? Including this one. Your mind is going to tell you that it's going to take out the strong high. It is not. The only thing that can take out a strong high is news. If you have a new spike, let's just say the euro has or the US dollar has good news, then EU would spike, right? internally now is what we're focused on. Anything taken to the left in terms of buy side is internally. And then now that we have a strong high and a new dealing range, everything else is external or inside of the dealing range. Oh, my bad. Internal, my bad. You have external, outside. Last time that for a buy side, the last time it's going to be taken is when you see the displacement higher into a POI. And once again, if it's not happened before the POI, as it here, there's another form of liquidity. It's not a form of liquidity. It's another situation where that happens, where you have price going into your POI and it looks like it'll sell off, but displacement has not happened yet, and then it'll take out the high that was in the POI and then continue down. That's perfectly normal too. So the only two situations. Be aware of both, especially the second one, right? So, because when you get price in your POI, you get price action, you can get positive price action in your favor. It can get you riled up. Let's see something. It can get you riled up, you know. It can get you excited for the trade, and then you start to prematurely enter, but you haven't got your confirmations yet. So terrible. So now you have internally, right? Now I know that all liquidity to the left has been taken, right? Now all you're focusing on after your displacement higher is either one of two things, right? You're gonna focus on more price action and then get in on the retracement after the highs have been taken out. Normally there's like an imbalance, or within this range, there's like an imbalance or an order block or something like that. And you're gonna know that price is not gonna violate the strong high unless there is news and you missed it, right? So price came up in this case, took all of the buy side liquidity right here. And as you can see internally, right? So you can think of this as like a phase one over here. Liquidity. I always have a hard time spelling that for some reason. So it's phase one liquidity. And then you can think of this as phase two liquidity over here on this side after the buy side is taken on the left there. So phase one liquidity, get your displacement. It's the last thing. Phase one's over after their displacement, meaning they're not going to come and strong high has been established. And then you move over to stage two, phase two liquidity, and you look internally in your dealing range, and you see that, hey, I know the strong high right here is not going to be violated. And you essentially find execute the trading plan, find some type of institutional footprint within the dealing range after all the buy side is taken, right? Little pro tip, right? This is how I used to draw buy side liquidity in order to get it right. Anything that's a lower high, take a strong high, typically is going to be taken. So you can think of it as a trend line that would come up and violate anything under this trend line, or you can move your buy side liquidity up to the highest high relative to the strong high and expect it all to be taken, and then have continuation. So with that being said, it's the same thing, right? Took all the liquidity internally. It didn't violate this high. It didn't worry about any more liquidity to the left after the displacement was done, right? Boom, came down, took out liquidity internally, but not all of the liquidity, because this would be a strong high. As you can see, it got respected. Price came down again, right? Still not worried about anything to the left. Still not worried about taking out any major highs, because now what this would be this whole area, each new dealing range, which would be every time a high is taken out, every time buy side is taken out and a strong high is established and price continues from there, right? That's going to be a new dealing range. So that's a strong high there. As you can see, it never got violated. And this phase two liquidity is going to be gone forever, right? No matter where you're looking at, you're still in phase two. There's only two phases of liquidity, and that's phase one liquidity externally when they're taking the buy side, and phase two liquidity when it's all internal inside of the impulse moves, right? So take out all those highs, come back up, some type of institutional footprint. I'm just going to draw this in for example purposes, but let's just say you had a 15-minute or 1H imbalance right here, for example. Or let's just say a 1H order block. Oh, come on, you're not going to see. So you have a 1H imbalance right there, for example. And let's just say that was filled and you had a continuation. That's an easy buy or easy sell, my bad. And now that you are breaking down here, right, where do you think your dealing range is? From the high to the low's low, right here. What happened? Price came up, right? And like I said, anything relative to new strong high is going to be hack. It's going to be destroyed. Price came up, right? And since this is so close to the strong high, it was not likely to be taken. This actually was the last up candle before the drop. There's a small imbalance here as well. So price came up. It took out the highs here. It took out the highs here. You can see buy side take. Still not worried about anything on the left. Still not worried about taking out all those highs. Crazy how that works. Price resumed from there. I probably wouldn't have taken this because it didn't come and fill this imbalance, technically speaking, and it also didn't come mitigate this order blockage. Kind of went up and took out a high. You could trade it based on order flow, and like it took out a high. As you can see, this is within this dealing range. This is a major swing high right here that it took out. Major swing low, major swing high, major swing low, major swing high. So now, what do you have right here? Right, you have another strong high. Right, took out buy side, established itself, continued down. You have another strong high. Shouldn't be taken, right? Not anytime soon, at least, if you're from an intraday perspective. Price came down, took out this low right here, right? You have a new dealing range officially after the low is taken out. What happened? Price came back up, took out a high, respected this imbalance. Still not worried about anything up here. You know what I mean? There's only 2 phases of liquidity. So once you have phase 1 done, all there is left is phase 2. Ooh, spicy. So it took out this high, but it didn't take out the high, and it didn't quite reach this imbalance here, to be honest. Felt very short of it. So that would have been a mistrade for me because I wouldn't have saw that, but you took out this high right here, short-term high, and this is when it starts to take out short-term highs, right? Anything that's within the new trading range, that's a high is going to be a short-term high. I specifically look for that to be taken out into premium territory. So in that case, you would go from here to here. Boom. Is it above the equilibrium into premium territory, which is from here to here? Anything above here, boom, premium territory. That would have been a good sell. And then you might have had optimal trade entry 2. What do you know? 62. Perfect. I would have probably taken that. All I need is three or more confluences for a trade to be able to take it, right? Same thing. From the strong high, new trading zone. Let's just say you're looking here. Boom. It traded above equilibrium, but it did not quite reach 62. I wouldn't have, and not even a turtle soup sell, to be honest. So I wouldn't have even taken that. But anyways, took out buy side here. New strong high is established after it takes out more sell side here. And what do you see happen, right? You go from where the liquidity was taken all the way down to the lowest low. Draw your Fibonacci. And even right here, like there's the imbalance fill right here, continuation. Price took out a high here. So actually, this is your new trading range because price took out a high here and had a continuation from that. And then you had 62% retracement again right here, right? Still not worried about that, right? You see how I adapted there? It took out this short-term high and then took out the short-term low. That's the displacement higher. That's the displacement lower. That's your new dealing range, right? Price came up to the 62. You had an imbalance here, right? We're still on phase 2 liquidity, by the way, which is just internally in the new impulse swings, right? In the new dealing ranges, right? Let's just say 1H fair value gap in the new dealing ranges. Look at that confluence in context, right? Let me move this so you can see the 62, right? Price continue down again, right? Repeats the process. Let me move the word phase 2 over here so you guys remember that we're still phase 1's over. Once phase 1's over, it's over, bro. That's it. It doesn't need to come back up. It doesn't need to, unless it's chasing some buy side. And the process repeats itself, right? Took out a high right here, took out the low, short-term high, short-term low. That's technically displacement higher, displacement lower. And then you had a continuation from there. And then the process just repeats itself over and over again in terms of internal liquidity, phase 2. So you have phase 1 liquidity and you have phase 2 liquidity. Phase 1 liquidity is going to be when, like I said, displacement needs to happen. Up until that point, until displacement happens, they will be chasing buy side. Every time a new high is created, until displacement happens, that high will be taken. And that also makes this, right, after the displacement higher, and then in the strong high, and then the process repeats itself as I just showed you. each dealing range, right? The top of each dealing range, right? Let me just delete some of these markups real quick, except for delete order block. I'm gonna keep the strong high, I'm gonna keep the displacements, right? These your trading ranges, right? Specifically the tops of your trading ranges, right? So like in this area, let's just say from this low to this high, these areas become what I like to call high resistance liquidity areas. That means prices are going to have a very hard time breaking these areas, right? Once price comes up and takes the buy side, price is going to struggle extremely bad on this area. In these areas, this specifically happens on phase 2 of liquidity, which is internally, is when they only take price internally. So you have phase 2 here, you have phase 2 liquidity here on that continuation, you have phase 2 liquidity here on this continuation, and it just goes on forever. You have phase 2 liquidity here on this continuation, presenting many opportunities over multiple days, right? So that same thing here. After your price took the buy side, came up, pretty much retested, but you know the daily order block came back down. Now this is your new high resistance area from the strong high to the nearest low. You're going to see and you're going to look and you're going to say this is going to be a very high resistance area. Anything above the buy side liquidity that needs to be taken is going to be a very high resistance liquidity area. So that means price is going to have a lot of trouble breaking anywhere near the strong high, and you should expect price to take out buy side into whatever footprint, and you can expect price to essentially print price action just like this, very weak, choppy price action after the buy side take. It's going to struggle out of nowhere, as you see here, plateaued practically, and then fail from there, right? So make sure you write those notes down. High resistance liquidity areas. For buys and sells, it's the same thing. Once the displacement lower is taken, right? Pull this down. Once displacement lower is taken, right? Once the low is taken out and you have sell side taken, right? This is going to be displacement lower and the price comes up, and that's going to be displacement higher. This is going to be a very high resistance from the strong low right here that was established. This whole range is going to be a high resistance liquidity avoid. And essentially when price comes back down here and takes out all the short-term lows, for example, here, in order to fill this imbalance or mitigate this order block, it's going to have a very hard time in this area continuing down. It's going to plateau just like I showed you. So same thing here, right? You had buy side liquidity take right here, right? Price took buy side. They have to check sell side next. They created some liquidity, came back down. The lows created as a result of the liquidity take, which is what you're looking for before you go along anyways. But then price came down and you have to wait for the displacement. That's not displacement, right? It's not going to go to displacement lower and then displacement higher. The displacement typically happens before it gets into your POI. So the low that's created after the sell side take for longs, you're going to expect that, and the higher to be created, and then displacement lower, displacement higher, and bounce fill continuation. And that's going to be a high resistance liquidity area right there as well. Price is not going to be able to break that unless there's some type of crazy volatile news. So with that being said, that's pretty much it for this video. My Mac isn't ready to die anyways, but that's pretty much it for this video. I wanted to show you guys about liquidity and how I view liquidity and what I'm thinking when I am trading the charts after asking my displacement and a little bit of price action. I typically can get in sometimes when there's after the displacement, as long as it has context, as I explained in the Cass vs. Frank trade breakdown. So if you guys have any questions about this video, go ahead and let me know. Questions, chat, send me a DM, something, and then I'll do a better job of explaining it. But that is how I look at liquidity and how I am able to get in so early. Oh yeah, before I stop, that's specifically after my strong high candle closes are established. I don't wait. If candles are running, I let them run until they close. I have to see what that candle is going to be. So if I see a bearish order block after a buy side take, after a displacement higher or something like that, that I'm looking for, then that's all right. They're showing you that's a footprint right there. So let me know if you have any questions.